I'm going to do my best, as usual, to make it as informative as I can for you. I know there's a lot going on in today's market. We had the inflation data that came out today. Obviously, that's going to be something we discuss today and how that feeds into market sentiment, Fed policy, liquidity conditions, etc. And, that's all important. It's important to keep all of this top of mind for the near term. But as they say, Rome wasn't built in a day. And your portfolio, your financial future isn't going to be built and finalized in one day. It's about the journey and it's about consistency, consistently making good investment decisions and doing that in a down-to-earth way where you're focused on the facts and you're weeding out as much emotions as you possibly can. So that's going to be our goal here, as usual, today. I'm Justin Klein, and on this radio show and podcast, I'm going to help you build the portfolio strategies and help you make good decisions. So the phone lines are always open, 888-99-CHART, 24 hours a day, 7 days a week, and I've got a lot of material to discuss with you today. My main focus point is in regards to what are bucket portfolios and how do they perform in 2022. Okay, so we're going to look at that. I also have some other topics on the docket for us as well. But ultimately, this is really going to be a show about your calls. So 888-99-CHART is how you get through and ask your question on today's show. And we love your live calls. Your live calls are what fuel this show. And so that's why I always encourage those calls as often as possible. Don't hesitate. I know this is I know you have questions. I know you do. And we have some voice bank questions to play for you. One is on Jackson Financial. And of course, we're going to get to your live calls as well at 888-99-CHART. Now let's take a look at the market today. We had a pretty good update. We had the inflation data, the much anticipated inflation picture, and it was pretty much in line with expectations. Not a whole lot unexpected on that front. Overall, if you look at the inflation data month over month, the headlines are always going to look at year over year. But remember, as you can tell from last year, 1 year can be drastically different. And when that happens, you have base effects. You have base effects that impact the numbers that you're looking at. Okay? And all you're doing is looking at the past 12 months when you're looking at year over year, right? 12 months ago. But what about, why not use the last 3 months, or the last 6 months, or 9 months, or 2 years? A lot of analysts do that. They use 2 years of data to figure out where the trend really is for this month compared to multiple years. Well, if you look at the CPI data that came in, it was actually negative 0.1% month over month. Negative. That's the first reading in negative territory for 2022, the last month of the year. And what's interesting, we were saying this for a lot of for the early part of last year, saying inflation is going to peak early in the year. And then you had the the Ukraine war, and suddenly things changed, right? The peak in inflation was pushed off until really second quarter. We thought it was going to be first quarter peak. And that's pretty clear. In June, we had 1.3% inflation month over month. In July, we had 0% inflation month over month. August, only 0.1. September, 0.4. October, 0.4. November, 0.1. And December now, negative 0.1. So on an annualized basis, if you take the back half of the year, we're only at 1.8%. Yeah, you heard that right. 1.8%. So when everyone says, oh, inflation is a big problem, yeah, I mean, if you're looking about base effects from 2 years ago, yeah, Prices are up. But it's pretty clear that the market's shifted. The market's changed. Okay. And ultimately, that's where we're at. The Fed, although they're going to raise rates, inflation has been killed. So I don't know what they're trying to do. Really doesn't make sense to me, to be honest with you. It's clear they're not really paying that much attention. And that's what worries me. They're not really paying that much attention. Why? Why is that? They said inflation was transitory. Well, was it? Yeah, it was. Eventually, everything's going to be transitory. So that was the market today. Good reaction. But we are heading into option next week. And I think that sets us up for, I think February will probably be more of a month where we retrench. But in the near term, we are on the up and up. Let's go to Matthew in Louisiana. Let's talk about taxes.
Hey, Justin.
How can I help you?
I had a tax question about I dollar cost average into an S&P 500 index fund.
Okay.
And some of my friends and I were having a debate the other day. Some of my friends seem to think that if that stock appreciates and you're holding it, that you have to pay taxes on unrealized gains. And the way I understand it is that I don't have to pay taxes on those gains until I sell the stock. Is that correct?
That's correct. Yeah.
Okay. You answered my question. Thank you so much.
No problem. Now, there are, just a caveat here, there are what are called capital gains distributions, especially for mutual funds. They can happen in ETFs, but ETFs are pretty tax efficient, so you rarely have that. But mutual funds, they can basically distribute capital gains to you and basically force you. But that's the only thing you probably have to worry about. But if you're buying, dollar cost averaging into ETFs, that's not really something you have much to worry about. Let's go to James in New York, who wants to talk about sectors.
Yeah, I was wondering what you felt recommended would be how much percentage of each sector should one have in their portfolio, and if we were shifting out or away from one sector and leaning towards another, would industrials and utilities be a good area to add to?
Well, what sector allocation you have, that a lot of that depends on your time horizon, your risk tolerance level. Okay, so that's number one. So it's hard for me to get a blanket. Oh, everyone should have 12% in this sector, 8% in this sector, etc. What I try to do is say these are the sectors you should be overweight. Your normal allocation. These are the areas you should be leaning on. Now, if you're looking at utilities and industrials, these are two different types of exposures. Now, they're not growthier names typically, but one would be non-cyclical and the other would be cyclical. Industrials would be cyclical. Cyclical stocks are doing well right now. I know it seems weird going into a recession, but remember, we're onshoring manufacturing. There's a massive, massive growth in CapEx spending to reshore manufacturing here in the United States. It's not discussed. It's not fun to talk about. It's not sexy, but it's happening. And so industrials are doing well. Utilities, they did well last year, comparatively, but so far this year, not nearly as well. So if I'm picking one or the other, I'm picking industrials over utilities. Okay, and a lot of that also has to do with valuation. Utilities, broadly, are pretty expensive. There's a lot of people chasing yield, a lot of people out there trying to, a lot of negative sentiment, and therefore money flows into utilities. But once the tide shifts, money flows out of those utilities, okay, and into cyclical sectors like industrials. And that's where money is going right now, and I think that will continue to do so for most of the year. Now let's make it 3 calls in a row, and this came in earlier at 888-99 sharp.
Yeah, this is Will in San Diego, and I'm looking at ticker symbol AMLP and wonder if this is a good investment. Thanks.
All right, looking at AMLP, Alerian, what was it? Alerian MLP? Yeah, so it's a ETF holding master limited partnerships. And I believe that this is, the good thing about this is you're avoiding the K1s that you get with owning individual MLP. So this is an ETF. So that's the positive here. If you're trying to gain exposure to the MLP sector, this is a good ETF to do that, and you want to avoid the K1s that come with these limited partnerships typically. Now the downside is that expense ratio is pretty high, 0.87%, 0.87%. So that's the biggest drawback here. So I like it as a very small percentage of your portfolio. I probably wouldn't go crazy on it, just because remember, these master limited partnerships, for the most part, not only do they produce a K1, but they also have pretty leveraged balance sheets. It's very capital intensive to build out these systems, and they use most of their cash flows to pay out in dividends as opposed to pay down the debt that they built up in order to build out these the infrastructure. So that's one reason why I don't love MLPs. Besides the K1 issue, now this gets around the K1 issue, but it still leaves that low leverage balance sheet. So I wouldn't go overboard and chase the yield. A lot of people are chasing the yield within this space, but I rather own a lower yielding pipeline company that isn't a limited partnership that pays qualified dividends. And that's another thing. That 7.7%, that's not going to be a qualified dividend. All of those dividends are coming from a limited partnership. So you have to take all of these things into account and not chase the yield. It's very important with REITs, with master limited partnerships or limited partnerships of any kind. Don't chase the yield. The yield isn't as plain as the yield that you get from a utility or from Procter and Gamble or any other big blue chip name. These are very different. You need to be cognizant of that and what type of account you hold it in. So thanks for the call, and hope that helped. Now we're heading into a break, and I welcome your finance and investment questions now. No question is too simple or too complex. You set the agenda, so give us a call now at 888-99-CHART.
It's a new year, but you've got finance and investment questions. So Justin Klein is here and ready to take your calls live. InvestTalk, 888-99-CHART.
So Dr. Gene in North Carolina wants to talk about K1.
Yes, thanks for taking my call, Justin. Yeah, you were just talking about K1s in terms of MLPs.
Mm-hmm.
I have a two-part question. I've gotten K1s before when I buy ETFs that are either negative or positively the daily leveraged, or even some that deal with commodities. I think it's because they invest in future contracts, or they have future contracts as part of their investment, and that appears. And what's been frustrating, it's a two-part question, it's been frustrating is that it seems to be spotty. I can hold the same ETF for 3 years, and 1 year I'll get a K1, another year I won't get a K1, another year I'll get a K1.
Mm-hmm.
And I'm wondering, one, has that been and all the ProShares leveraged ETFs seem to be structured as MLPs, by the way, it seems to be. Two-part question. Has that been your experience with some of these ETFs? I know there are some ETFs specifically that says it's K1 free or no K1. And also, the second part of the question is, in your model portfolios that you have for your clients, do you intentionally try to avoid investing in any position that would generate K1s?
The answer is yes, we do. And we don't use really ETFs very often. It's very rare that we'll use ETFs. And you're right, most of the ones that produce some sort of K1 are in relation to gold or are levered in some way. And so, we don't use either of those. So commodities in general. We buy physical companies that produce commodities, right? That mine for commodities. So we're not typically playing commodities via an ETF. They're usually bad ways to play commodities anyway, because they're using, like you said, futures contracts. There's cost to rolling those futures contracts. You're going to get much better bang for the buck by owning good quality commodity producers that pay dividends, that have good management teams, that have good assets, etc. Much better. So we don't really buy ETFs to play the commodity space really at all. So yeah, that's the answer to your question. And this is a very important thing for everyone to understand, whether you're buying mutual funds, ETFs, individual stocks, because K1s are a big headache, a huge headache. And if you own assets that produce a K1 within a tax-deferred account like an IRA or a 401k, you're kind of defeating the purpose of having that, okay? Of having a tax-deferred instrument, because you're investing money that's taxed, and that is taxed, right? Any gains on that.
Right, they still apply to qualified accounts. Right.
Exactly. So you want to if you're going to buy them, you want to do it in taxable accounts only. And then you still have to get a K1, right? You still have to deal with it, and maybe your CPA deals with it, and maybe you don't have to, it's not really a headache.
Again, there is a small number of ETFs that essentially, even in the title, say it's K1 free or no K1 as an alternative. But
yeah, like I said, Alerian MLP, it was that last call. That's all about that, right? That's to avoid the K1. But it doesn't mean that that's the only factor. Just like everything, there's multiple factors to consider, and these K1s are underappreciated for most people, especially those that are searching for dividends or exposure to commodities in some way. Thanks for the call, Gene. Let's go talk to Luke in Wisconsin, looking at IIPR.
Hey, Justin. I just have a couple quick questions about IIPR. As I'm digging deeper into their balance sheet, I see about 33% of their property assets is in tenant improvements. I was just wondering if you could make more sense to me. The way I understood it is they're kind of lending money out to their tenants, and then their tenants are just paying them back. But I'm worried that some of their higher risk tenants are kind of keeping them afloat. As I look at some of their contracts, a lot of these tenants are, struggling with their cash flows, and their stocks are really depreciating if they're a public company. I was just wondering if you could make more sense for me, and if you could let me know your opinion on IIPR. Thank you.
Yeah, we like IIPR, and what you're talking about is money that they put into tenant improvements within their facilities. Right? You buy an empty space, you get it licensed for cannabis production. And for anybody else out there, IIPR is Innovative Industrial Properties. This is a REIT that basically leases space to producers or companies within the cannabis space. Typically, they are they're growing cannabis within the facility. And obviously, that's highly regulated. And IIPR will do the legwork to get everything licensed and set up to run properly based on local regulations, and then they'll lease it out to a publicly traded cannabis company or privately owned. It doesn't matter, but that's basically what they do. And what you're talking about is their balance sheet, and tenant improvements is saying, just like any commercial property, the owners often will have an allowance. They will go in there and they will spend money on improvements. And the good thing about this business even more is that you can, even if they get a tenant that stops paying and they default and they move out, they're just going to bring someone back in, and they don't need to change the setup very much, right? They already did all the tenant improvements to grow cannabis or whatever, and there probably isn't a whole lot of changes need to be made. Whereas other commercial properties, you have a tenant move out, it might be a whole different type of tenant, and you need to scrap the whole thing and redo it. So we still like IIPR. It's probably the best way to play the cannabis space at the current time in the public markets. Now, next, InvestTalk, the story behind this question. Should you be looking at closed-end funds? We're going to get to that story tomorrow, but for now, I'm Justin Klein. I'm ready to take your questions live at 888-99-CHART. We've started the new year, and I thought it might be a good idea to let you know about a new way to make your meal preparations easier. If you are ready to get farm-fresh, pre-portioned ingredients and seasonal recipes delivered right to your doorstep, HelloFresh was made for you. Now you can skip trips to the grocery store and count on HelloFresh to make home cooking easy, fun, and affordable. That's why it's America's #1 meal kit. With HelloFresh, eating well in the new year can be stress-free and delicious. With over 35 weekly recipes, they have the options you're looking for to help you achieve your goals. Choose calorie smart and carb smart recipes, or even customize select meals by swapping proteins or sides, upgrading your proteins, or adding protein to a veggie dish. When it's time for the game, you can home gate like a pro with a limited time and winning assortment of snacks, appetizers, and shareable sweets available at HelloFresh Market. Treat friends and fans to delicious barbecue baby back ribs, chocolate chip brownies, and everything in between. We all want to save money this time of year, but did you know that HelloFresh helps you save money all year round? HelloFresh is less expensive than grocery shopping and 25% cheaper than takeout. I found that it's actually a pleasure to cook with HelloFresh, and I like to collaborate with my girlfriend as we try various HelloFresh recipes. We agree that eating well is top of mind, and it's comforting to know we always get top quality ingredients with HelloFresh. HelloFresh ingredients travel from the farm to your doorstep in under 7 days. That's how you know they are fresh. So, go to HelloFresh.com/invest21 and use code INVEST21 for 21 free meals plus free shipping. That's right. Go to HelloFresh.com/invest21 and use code INVEST21 for 21 free meals plus shipping. Try it, and you'll discover why HelloFresh is America's #1 meal kit.
One of the most rewarding things I do each weekday is host the InvestTalk podcast. I truly enjoy helping investors, and I know that every question counts and every answer I provide will be unbiased. So as long as your questions involve the stock market or general investment topics and definitions, we set no limits. You, the caller, get to chart the course for each InvestTalk podcast. Justin and I are ready. Are you? Call with your questions anytime, day or night, 888-99-CHART.
Good luck to John. He's in North Carolina looking at Hawkins Incorporated, small cap company. The owner looking to buy it.
I've owned it in the past. I've bought it a couple times in the last 2 years and kind of maybe swing traded it a bit. And now I'm looking at getting it back in. The thesis is it's in that materials space. It's involved in water treatment. It has a reasonable valuation, kind of low dividend, low payout ratio. Kind of hits on a few themes that you and Steve have mentioned over the last few years. So, yeah, small cap, materials. I kind of wanted to get your opinion on it and see what you thought about it.
All right, it's a small cap name, about $800 million market cap. Majority of its revenue comes from the United States. So, like most small cap names, it's more domestically focused. It does do a lot of water treatment and produce a lot of chemicals for that, including some health and nutrition segment as well. So ingredients in food, beverages, personal care. Overall, I like it. I like what you're looking at. I like the type of company. Return on equity right now is 19%. Now, it's probably over-earning right now. Longer-term average is closer to 13%. That's the median over the last 5 years. So it's probably over-earning a bit here, and you can see that with earnings downgrades over the last, or right now, recently. You have next year, earnings just to fall 4%. But still well above pre-pandemic levels of $1.14, so let's make $2.68 next year. Not a big dividend yield, 1.4%, which I'm fine with. I actually like those smaller dividend yields that have room to grow, and it certainly does. The payout ratio is only 19%. Let's look at this last dividend. Have they been raising their dividend? Yeah, they cut it back in 2018, but it's been rising since 2020, so that's good. And there's room to run there. Overall, I think it's pretty good. Very minimal debt, trading at enterprise value to EBITDA about 8.6, so it's not expensive on that front. I'm going to give this overall a thumbs up. Let me take a look at the chart real quick. Sometimes you hit the wrong key. Yeah, it's into some. It hit some major support right around 35, $36, and just bounced up to about 39 to close today. So I would give this a thumbs up. I think it's relatively cheap. Earnings are coming down, but it's in the space that I like, and I like that they don't have much debt at all. So I'm going to give Hawkins a thumbs up. Now, my focus point today concerns the story behind this question. What are bucket portfolios, and how did they perform in 2022? And this is coming from Morningstar, and they do create different types of bucket portfolios: aggressive, moderate, and conservative. And aggressive, moderate, and conservative is all relative, right? That's why we try to use volatility questionnaires to figure out what people are comfortable with when it comes to their portfolio. We put a number on it, as opposed to just broadly aggressive, moderate, and conservative. But this is how Morningstar does. And they do it in two different ways. They use mutual funds. A lot of them are active mutual funds. Some of them are more indexes. They use a mix of those on the mutual fund side. And on the ETF side, it's almost pretty much all indexes. They do have a dividend appreciation fund. They do have, what else? An emerging markets bond fund in there. They have a few ETFs that are a little more active, more on the bond side than the equity side. But what's interesting here is there wasn't a whole lot of difference in the performance overall between aggressive, moderate, or conservative last year. Now, the aggressive one have about 8% cash, moderate 10% cash, conservative 12% cash. So that's where you're seeing that not a huge difference in the performance, because not a huge difference in cash levels. And both stocks and bonds fell a good amount last year. Now, they're fairly well diversified, where they have things like TIPS. They have TIP funds in there. They tend to lean on more income focused strategies and value type strategies. They don't have a ton of growth focused mutual funds or ETFs here. And I think that's what prevented them from having heavy losses. They all saw losses anywhere from about 7.5% to 11% on the year. Okay. And so not terrible, especially compared to the NASDAQ, down a third last year. But they're well diversified. And so the lessons you can take here is that last year being focused more on the value side was better. We kind of know that. And you're starting to see the mutual funds did better. Previously, the ETFs were doing better. They were more index funds. They outperformed the more active funds. Last year was the start, for the first time in many years, where the mutual fund side of their bucket portfolios did better because of that active nature. And I talk about this all the time, that there are longer term trends. There are trends where indexes outperform. There are long-term trends where more active management outperform. And it's usually that switch usually happens at extremes. And that's what you saw in 2020 and 2021 was that extreme allocation to indexes and to the growth stocks, and that's all reversed. And what happens then is once that reverses in a big way, like it had last year, suddenly all the money that's been crowding into that over-invested trade, in this instance, indexing, that starts to trickle out and it feeds on itself. Okay, and then you have the backdrop of higher inflation, higher interest rates, that also moves money into those more tangible names, the value side of the market, and that's what you're seeing so far. So that's really the lesson you're getting from the performance of their bucket portfolios for 2022. Now let's pivot back to the InvestTalk voice bank to play a question that came in earlier from Denmark.
Hello, InvestTalk. This is Yannick from Denmark. I have a question about the stock Jackson Financial, JXN. It's extremely undervalued, I find, but it's relatively new on the stock market. So I don't know much about this company, but it's really, really undervalued. Therefore, I would like to hear your opinion. Is this a safe investment, even though it's definitely not a blue chip stock? Thank you. Bye.
All right, looking at Jackson Financial, and you're right, it hasn't been on the market for very long. 2016 was the first year I see of earnings reporting. It went public, looks like in 2021, 6% yield, and it does look very, very cheap based on earnings. But as we know, earnings can be massively misleading. And it looks like they have a lot of long-term debt. All the numbers line up except for the enterprise value is negative in a big way. I really want to know why that is. I'd really have to dig in the balance sheet of this. What I don't like is the business that they're in. They sell annuities. And there continues to be a push. And I think the push will eventually get through. And that is to hold all financial advisors to the fiduciary standard. Now, we at KHB Financial, we are a fiduciary. We're a registered investment advisor. All sole independent registered investment advisors are fiduciaries. Now, some will say that they are RIAs, registered investment advisors, but they're also brokers. We are not. But some wear both hats, and you never know which hat they're wearing. They might sell you an annuity one time, and they might manage a portfolio another time, and you don't know which hat they're carrying. But Jackson just sells annuities, and that's more of a broker thing. And that broker, that conflict of interest, that the commissions for selling loaded mutual funds, insurance products, annuities, there's a huge conflict of interest there. And that's why the vast majority of people that buy those things, they regret. Why? Because usually not the best investment for them. But it is the best investment for the salesperson to make big commissions. If you buy an annuity, typically the seller of that annuity is earning about 10% commission on it. That's why it's a big business. You get somebody to put in $200,000, which, in our industry is not a huge account, but it's something. You're getting $20,000 by getting them into an annuity. Some of them even will pay you over time, a kickback. Maybe you earn $20,000 up front and then $500 a year for as long as they hold that annuity. Obviously, each one's structured differently, etc. But that's really the risk here. And I don't like the complexity of their balance sheet. I'd really have to dig into that. It looks very complex from on the surface level. And a lot of these insurance companies are. So be wary of that. Now, the technicals are fine. And, it's probably going to hold up near term. So I have no problem with it in the near term, but long term, not an investment in my mind. Well, now it's 2023, and probably makes you realize that retirement day is right around the corner. May not feel like it, but it'll come faster than you think. And that means you need to keep your eye on the ball and update your strategies for your particular situation. What are your goals? Where are you at today? What's your risk tolerance level? How much are you saving a year? All these, plus many more, are factors that go into whether you are on track for financial freedom. And so, if you need help understanding whether your direction is the right one, I encourage you to reach out to myself or Steve Peasley at our company, KPP Financial, where we operate with the same philosophy as we do on air, which is independent thinking and shared success. We want to bring you along with our success, with our value investing approach that is, frankly, outperforms long term and definitely outperforming right now. So this is where we implement unbiased guidance, both on and off air, and we practice parallel investing, which means we invest right alongside our clients. So I encourage you to take advantage of our free portfolio view assessment via telephone or GoToMeeting. Just send us a message through investtalk.com or give our office a call at 800-557-5461. The sooner you reach out to us, the sooner we can help get your portfolio optimized. Now, next up, I'll tackle another InvestTalk caller question, so hang on.
In today's world, a variety of factors are affecting the stock markets. Serious investors know building a secure financial future requires hard work and determination. That's why now, more than ever, when it comes to the planning, execution, and maintenance of your portfolio, you need InvestTalk. InvestTalk is a free download. Your participation makes it unique. Don't forget to call InvestTalk 888-99-CHART.
Hey guys, love your show. I just wanted to get your opinion on the ETF AVGE, Avantis All Equity Markets. I listened to the podcast, and thanks for all you do.
All right, this is Avantis All Equity Markets ETF, AVGE. It's a global large cap blend. Let me look at the portfolio. It says all equity markets. I think that's why it's a global. That's what they're trying to say. It's global. About 29% of the portfolio is non-U.S. stocks. 71% is in U.S. stocks. And only about 13% of the portfolio is in technology, 13% in industrials, 10% energy, 7.5% basic materials. Financial services, 19%, pretty high there. Definitely leaning on the value side of the market, which is good. It's not in the small cap. So if you're looking for maybe lower volatility and general outperformance for the broader indices, I think this is pretty good. I like it to lean a little bit more on the mid and small cap, but overall, it's pretty good. Now, the question would really be on the fees. You are paying, let's see, the expense ratio is 0.23%. Not too bad. Not too bad on that front. So I'm going to give this one thumbs up. Definitely better than buying the S&P. That's for sure. But I would want a little more small and mid-cap exposure. Thanks for the call. 888-99-CHART, 888-992-4278. Now we're going to head into our final break. But after the break, I want to touch on closed-end funds. Closed-end funds. This has been a popular place for people to chase yield. And that's starting to come back to bite many who didn't understand the leverage within the space, didn't understand where that yield was coming from and what the risk was to that yield. So we're going to look at that after the break. But we also have time for your call. If you make it, actually, we're going to talk to Ricardo from California. He's going to be up next as well. So if you want to jump in before the close, you can give us a call at 888-99-CHART.
Got a question for Steve or Justin?
I'm calling to ask you opinion on an ETF called XLI.
And the question is, during the market downturn, do dividends stay fairly steady?
And I've got a question about warrant shares. I think that's the right term.
A warrant is a right to buy shares of stocks at a certain price.
What's your question? Now is a good time to call InvestTalk. 888-99-CHART.
Justin Klein and Steve Peasley are ready to take on your finance and investment questions. So don't forget to call InvestTalk, 888-99-CHART.
Go to Ricardo in Linwood, California. He wants to talk about ETFs.
Hi, Justin. I have a quick question. What do you think of CD laddering versus ETF investing for a young investor who's not active in the stock market but wants to stay invested for the longer term?
Well, what type of ETFs are you talking about? Like just buying the S&P?
Yeah.
Well, you're talking about two different types of investments. CDs are very safe, very low yielding. Better yields today than you have in the past, but still, CDs are around 4%. Equities, longer term, they tend to earn closer to 10% annualized long term. So with a lot more volatility than a CD. So, but you're young and you probably can handle that volatility. So I'm going to say you want to be allocating towards equities. So I would say ETFs, but your own personal risk tolerance. How willing are you to handle market volatility?
Okay, so basically, investing in the indexes for the longer term would be a better choice.
For the long term, yeah, absolutely. CDs are very safe. You have no credit risk there. You have no volatility because they're not traded. You're just getting your yield. But also that yield could fall, right? You buy a year CD, the Fed cuts rates. A year from now, that might not yield 4%. Might be 2%. So you're talking about apples and oranges here. Talking about a very safe fixed income security, a CD, or an aggressive, risky equity security. Very different. Apples and oranges. Thanks for the call. Now, lastly, let's talk a bit about the closed-end fund market. And some pretty big closed-end funds are cutting their payouts. And these are very popular investment vehicles. About $270 billion are invested in these closed-end funds. But some of the biggest ones are cutting their yield. The PIMCO Municipal Bond Fund slashed its dividend by 45% this month. Nuveen LLC endured a 6% cut. Eaton Vance cut theirs by 24%. 6 BlackRock mutual funds, muni funds, cut their payout last year as much as 38%. Now, the reason this is happening is because of leverage. Leverage cuts both ways. And this is a perfect example of people chasing yield. Closed-end U.S. equity funds returned to minus 20.6% last year versus the S&P, down 18.1%. The taxable closed-end bond fund was down 19.4%. The average muni bond fund was down 23.4%, compared to 8.5% for the muni bond index and 13% for the taxable bond index. So much bigger losses than the indexes they follow because of leverage. And that's how they're getting 8, 10, 12% yields from bonds, is leverage. And what happened is they're borrowing short and they're investing in these low yielding securities 18 months ago, during the time when rates were rock bottom. And you're borrowing at 2 or 3 and you're investing at 3 or 4, you're earning some extra yield. But now that's flipped, right? That short-term rates are going up and it's eating up the extra yield you're getting by leveraging up the balance sheet of these closed-end funds. And the munis are being hurt even more because their yields are even lower than those taxable bonds that they own. And that's why they are experiencing the deepest cuts. And about 4 million U.S. households invest in closed-end funds as of 2020. Nearly half of investors in all of these are retired. So a lot of people are living off this income, and now it's being cut. The median age of the owners, 54, with an average household income of $135,000, a median net worth of $500,000. And this isn't because there's one reason. It's leverage for this, because there are funds that are actually raising their yield. The Nuveen New York Municipal Value Fund, Municipal Bond Fund, actually raised its payout by 13% last year. Since June. Why? Because it doesn't have leverage. So this is another lesson that when you're chasing yield, you need to know where that yield's coming from. Is it sustainable? Is it because of leverage and too much debt? Is it because of potentially the business is going to go away? If it's yielding that much, there's a reason for it. And a lot of those reasons are now coming home to roost, especially those in the bond market. I'm Justin Klein. This is another InvestTalk program. Steve Peasley and I thank you for listening. We encourage you to tell your friends and family about our free podcast download, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. Independent thinking, shared success. It's InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights.